Stop writing ESG waffle. Integrated reporting is the SBL way to explain how a business creates value over time. Students often treat it like a sustainability essay. That is the trap. Integrated reporting is not just ESG. It connects strategy, governance, performance, risk, and resources into one story about value creation. A weak answer says the company should disclose carbon emissions because stakeholders care about sustainability. A stronger SBL answer explains how environmental limits affect costs, brand trust, supply chain resilience, risk exposure, KPIs, and long term cash generation. The key question is simple: how does this organization create, preserve, or erode value in the short, medium, and long term? Think of the report as a value creation engine. The organization starts with inputs. It uses those inputs through its business activities. Those activities create outputs, and those outputs create outcomes. Inputs include people, finance, brand, technology, relationships, and natural resources. Outputs include products, services, waste, data, emissions, and customer experience. Outcomes include profit, trust, capability, resilience, damage, or long term opportunity. That is the story students need to explain. The six capitals are a thinking tool. They are financial, manufactured, intellectual, human, social, and relationship, and natural capital. But do not list all six just because you memorize them. Use the capitals to spot what the scenario says the organization depends on. If the case is about funding pressure, financial capital matters. If stores, systems, or delivery infrastructure are weak, manufactured capital matters. If the company depends on brand, data, or licenses, intellectual capital matters. If staff skills, culture, or turnover are central, human capital matters. If customers, suppliers, regulators, or community trust are under pressure, social and relationship capital matters. If energy, water, waste, or climate exposure affects the business, natural capital matters. The business model is the bridge. Integrated reporting links what the entity uses, what it does, and what changes because of it. So the answer should connect strategy, governance, performance, and outlook. Strategy explains where the organization is trying to go. Governance explains how leadership supports accountability. Performance explains whether the strategy is working. Outlook explains future uncertainty and likely consequences. The report should cover the organization and its external environment. It should explain strategy and resource allocation. It should discuss risks and opportunities. It should report performance and KPIs. It should show governance, and it should explain the future outlook. In SBL, those content elements become practical recommendations. Now apply it to a scenario. Suppose staff turnover is rising after a rushed expansion. The fact is, staff turnover is rising. The capital is human capital. The value impact is lower service quality, weaker culture, and possible loss of customer trust. The reporting action is to disclose retention KPIs, training plans, and capacity risks. That is application, not memorization. Here are the mistakes that lose marks. Mistake 1: writing only about climate. Integrated reporting is wider than natural capital. Mistake 2: listing all six capitals. Select the ones the scenario actually depends on. Mistake 3: no link to strategy. Show how disclosure supports objectives and trade-offs. Mistake 4: no KPIs. Reports need measures, targets, and trend information. Mistake 5: no future view. SBL wants short, medium, and long-term consequences. Use this 4-part sentence because use the exhibit fact. This affects name the capital and stakeholder, which means explain the value impact over time. Therefore, recommend a specific reporting improvement. For example, because staff turnover has risen after expansion, human capital is under pressure. This may reduce service quality and long-term customer loyalty. Therefore, the integrated report should disclose retention KPIs, training, investment, and capacity risks. That is how integrated reporting becomes SBL marks.